This is an annual survey that we do on global indirect taxes and direct taxes. Last year's survey showed us that indirect taxes are proportionately becoming more important around the globe. So we wanted to do a little bit more detail on that this year.
Now, what does the survey seek to address in the market?
We wanted to know how large companies are addressing indirect tax risk. There's a lot of visibility to corporate tax because you have an effective rate of tax which tells you what a company's attitude to tax management is. But there's no similar measure for indirect. So in many ways it's a stealth tax.
But VAT errors are now being considered a greater risk than corporate tax errors. Why is this so?
VAT system places a lot of strain on a company's working capital. It's important that finance directors are focused on this risk because it can have a very severe impact on the profitability of a business if they make an error.
What are the implications of VAT errors for both local and overseas companies?
Well, first off, additional tax may be irrecoverable. If you can't get it back from your customer, then you'll have to bear the burden. Even if you can recover it from the customer, you're likely to face interest and penalties which won't be recoverable.
How does South Africa's VAT system compare with other markets, and what still needs to be done?
The VAT system here is relatively new. 1991 saw the introduction of the tax. So when you compare that to the European model, where it's been in since the 1960s, we're still relatively young in terms of system. It works quite well. The tax take is very significant. It's the second most important tax in the Treasury in South Africa. But there are lots of uses of the system that we don't use. The system here is very broad-based, affects a lot of supplies of goods and services, and we don't use the tax as a method for implementing social change as is elsewhere. So an example is medical care. South Africa is one of the only countries I know of where medical care is subject to VAT at 14%. Almost everywhere else it's exempt from tax.
Dermot, South Africa is currently ranked 17th in the league table of VAT friendliness. Why is this so, and what still needs to be done?
South Africa's position is exactly mid-table. We asked 520 companies around the globe to view their attitude of countries where it was easy to do business from a VAT perspective. And South Africa comes mid-table. So that's quite good. But unfortunately, it's a little bit disappointing. We come behind some countries such as China, because they execute tax evaders in China. So it's hardly to say that it's a friendly jurisdiction. In this country, we welcome the separation of administration and policy between Treasury and SARS. But there is more to be done. Maybe now is the time, 17 years on after the introduction of the tax, to review it as a holistic approach. We have a very fragmented system. We've legislation, primary legislation, regulations, lots of rulings, etc. And maybe it needs a complete review to give business certainty going forward.
Now, what is your take on the majority of global businesses believing that government is going to rely more heavily on indirect taxes, such as VAT and general sales tax?
Yeah. Over 2/3 of the finance directors who responded to the survey said indirect tax was their biggest concern, and they saw that continuing for the next 5 years, which was quite interesting. Indirect tax is an easier sell for governments to manage their tax take, both politically and economically. It's preferable over income tax or corporate tax because there's a lot of global competition to attract inward investment, depending on your corporate tax rate. VAT hasn't been looked at in the same light. So it is an easier sell, and it's easier to manage change. You can change the tax base, i.e. the things that are subject to the tax, or you can manage the tax rate. We all like to have more money in our pockets, so increasing income tax isn't going to be politically popular. We at least feel that we have a choice when it comes to indirect tax because it's an expenditure tax. We don't pay the tax until we spend the money.
Okay, that's all we have time for tonight. Thank you very much, Dermot. If you need any further information about this interview, please take a look at the next issue of Tax Talk, or you can contact Tax Talk on 011 476 5048. Until next week, goodbye.